Good morning to American audience, and good evening to Asian audience, and good afternoon to the European audience, and welcome to the Columbia University SIPA webinar series on central banking in the COVID-19 era. And today's topic is implications for central bank independence. And we have three great panelists, and I will introduce very briefly. They have a long bio, but I will introduce very briefly three panelists and move to the initial remarks. So the first panelist is Governor Veerathai Santiprabhob. He's governor of Bank of Thailand since 2015. And he's the chair of BIS Central Bank Governance Group. So he's a perfect speaker to this panel. Second panelist is Professor Athanasios Orphanides. He's a professor of practice at MIT Sloan School and he was former governor of the Bank of Cyprus from 2007 to 2012. And the third panelist is Professor Kathryn Judge and Harvey Goldschmid Professor of Law at Columbia Law School. And she is editor of Journal of Financial Regulations. And I'm Takatoshi Ito, professor at SIPA, and I will moderate this panel. So first, I will ask each panelist to make 5 minutes initial remarks, and then will be followed by discussion by Professor Patricia Mosser, and move on to Q&A from the audience. So audience people, probably it's best to send questions in chat box in this webinar technology, or Q&A box, either way. Then I will sort out questions and I'll ask questions on behalf of audience. Okay, so let us begin, and I will go in the order that I made introduction. So, Veerathai, please make initial remarks.
Thank you. Thank you very much, Taka, for the invitation. Very delighted to participate in this event. The COVID pandemic is an unusual crisis for all countries around the world. Central banks are very much used to financial crisis and economic crisis, but this COVID pandemic is a health crisis that has become an economic crisis. So we can't rely on our playbook that we all have developed for dealing with financial crisis. But central banks were very quick in deploying unconventional policies when the crisis hit most countries. Most of the central banks have lower interest rates to historic low level. We have also deploy a lot of balance sheet measures, including purchasing of government bonds in primary markets for some central banks. Some central banks have to go into the corporate bond segment, which central banks were not used to, particularly central banks in emerging markets. We also have to provide some forms of targeted lending facility to the vulnerable groups like the SMEs. And some central banks, including the Bank of Thailand, had to declare debt moratorium for certain segments of borrowers. So these policies were needed, in my view. And early on in the crisis, these policies were aimed at addressing illiquidity problems because the pandemic hit everyone by surprise, and most countries had to implement lockdown measures. And so the immediate needs for most central banks is to make sure that the financial markets can continue to perform to make sure that it would not lead to financial instability that could trigger a financial crisis. But going forward, as we all know, this pandemic will be with us for a few more years, and we have to shift our focus from addressing illiquidity problems to insolvency problems. And this is another big problem that central banks are not very familiar with. But looking back, to link all this with central bank independence, these measures that we have implemented will have unintended consequences. We have implications for the long-term independence of central banks. But if we did not take these measures in time, it would also have implications on the credibility of central banks that will also undermine central bank independence over the long term. Let me highlight some of the risks related to central banks' independence and also to the overall functioning of the financial system and the economy, which can have implications for central bank independence over the medium term to long term. Firstly, many of the measures that we have implemented will have implications for the institutional arrangements of central banks. So the first set of risks would be risks related to the institutional arrangements of the central banks. We might, or some central banks might lose independence over decision making for monetary and also on financial policies. Some central banks had to provide deficit financing because, as we all know, in a pandemic like this, fiscal policies would have to take the lead in putting income back into the wallets of people. But some central banks in emerging markets, the source of deficit financing is limited. So some governments have looked at central banks for low-cost financing. Many of the central banks, when they embark on unconventional policies which rely on the expansion of the balance sheet of the central banks, implying that certain central banks will have to take on more credit risks, more market risks, that could lead to losses for central banks in the future. And when central banks have to face with losses, it opens the door for future political interference. And another point that I should make, with a lot of unconventional policies that central bank could deploy in a very timely manner, it makes the public now realize how much power the central banks have in creating liquidity, and they might ask for more and more liquidity to be injected by central banks. So these are some of the examples of risks related to institutional arrangements of central bank. The second set of risks that I would like to highlight is risks related to financial stability over the medium to long term, because the low interest rates that central banks have executed, that could lead to search for yield, could lead to underpricing of risks in financial markets. Indeed, we saw this underpricing of risks even before the COVID pandemic. But with a lot of measures that we have implemented, we will see more divergence between economic fundamentals and asset prices, and this could lead to financial instability in the future. And many central banks, we also have to expand the scope of our measures to cover the non-bank financial intermediaries. Central banks are used to regulating banks. But this time around, we have seen a lot of irregularity in the non-bank market, particularly the corporate bond markets. So this is a step that the central bank has to step out of the usual territory, and these are the second set of risks related to financial stability. The third set of risks that I would like to highlight is the risks to the long-term strength of financial system. Regulatory forbearance has been deployed by many central banks, including relaxing on loan loss provisioning requirements, promoting debt rescheduling, creating incentives in the financial system so that banks can become more proactive in debt restructuring. The like of declaring debt moratorium, that will also have implications for the balance sheet of banks. So we have to be mindful of the possibility of creating unintended fragility in the financial system. And the last set of risks I would like to highlight are risks related to the long-term strength of the economy. Many central banks have deployed a lot of unconventional measures at a very large magnitude. And there's a possibility that we could unintentionally keep the like of the zombie firms afloat. This crisis, there is huge excess production capacity. It's unavoidable that we need to restructure the real economy. And by restructuring the real economy, it's unavoidable that we need to be consolidation across different sectors. Certain central banks measures could delay the needed restructuring and thereby creating zombie firms over the long term. With these risks in mind, I think there are many measures that we can undertake to minimize the risks related to central bank independence. I think firstly, the central banks have to make it explicit that they are in control of the measures that they have deployed. We have to show the public that these are the measures that we have initiated, we have executed, with the independence of the central banks. There is a risk of losing independence if the public perceive that many of these measures have been executed at the request of the government or not at the will of the central banks themselves. So I think it is very important that we are in control of the process from the design, the execution, and also the exit from these unconventional policies. The second measures that we could do is that we need to emphasize that these measures are transitory to address just only the pandemic. Many of the measures that we have deployed at the Bank of Thailand have ended explicit, so that after 2 years, these measures will be withdrawn gradually. The third possibility is to have a clear burden sharing between the government. Many of these measures are of quasi-fiscal nature, and when we have to take on some credit risks, some central banks have to have a clear burden sharing, whereby central banks would accept the financing cost of the measures. But when we talk about credit costs that could incur in the future, that's we have to be the burden of the government. And lastly, communication to the public is very key. We need to communicate regularly, proactively to the public, particularly on the point that there is a limited resources, there is a clear intention of why central bank has to come in. We cannot help everyone. I mean, in a crisis like this, the public, the SMEs, the business people, they expect the government and the state, including the central bank, to come in and help everyone. If we help everyone, no one will survive, and we end up using up all our limited resources. So I'll end here. Thank you, Taka.
Thank you, Veerathai. It's good to hear the situations in Thailand. And second panelist is Athanasios Orphanides, and he as I mentioned, he was governor of Bank of Cyprus and part of the Euro system. And ECB is supposed to be the most independent central bank in the world. So Athanasios, please give us your perspective.
Thank you, Taka. And let me first say that it's a great pleasure to be at this panel. Veerathai's remarks really apply to every central bank around the world, including the most independent. That indeed, as you mentioned, is the ECB. Let me start by reiterating a couple of points of agreement, and then expand on my own remarks. We need to realize the difficult situation that the pandemic has created. It really required a very forceful monetary as well as a very forceful fiscal response. We have a recession that is an engineered recession. It's an engineered recession by public policy, and it's the job of public policy to also ameliorate the effects. But most of the response ultimately has to be fiscal, the temporary fiscal support that is required. And Veerathai mentioned, including suspending in some cases the repayment of debts and so forth. These are all fiscal things. These are not really the traditional bread and butter job of central bank crisis management. And this is what makes it very difficult. Let's remind ourselves why it is that we want to have central bank independence, why we consider it so important, and how we defend it. We want to have central bank independence in order to be able to have in our societies technocrats who will be able to take the tough decisions that are politically difficult to take. Remember, as Chair Martin at the Fed used to say, have to take the bunch away, take the bunch ball away from the party just as the party is going. This is not something politicians ever want to do. This is why we want to have independent technocrats who will be able to do this to benefit society over the long run. Let me also mention how we cannot defend independence and remind you how central banking started. Central banking started as an operation to help governments finance themselves, the sovereigns finance themselves, help them get money and spend it. And we cannot defend central bank independence if central banking is in large part about how to spend money, what sectors to help, which nice projects and social goals to support, where to funnel money in order to help in difficult situations. And this is what makes the current situation very, very tricky for central banks, because we want central banks to use the power of their balance sheet to help fight this recession, but it has to be done in a way that does not give the appearance that central bankers all of a sudden have all of this money that they can be funneling left and right, that politicians would very much like to do. Because if this is the impression that is being given, then central bank independence will not last. It just cannot be defended. Now, why is this an issue that is very important right now, much more so than a generation ago? Well, this is a combination with a very low interest rate environment that we have around the world. We have a number of central banks that could not really help by easy monetary policy with cutting interest rates anymore. Cutting interest rates is easy. You provide easy monetary conditions without showing the spending power of the central bank. So what do we have instead? Well, instead we have the very large expansions of balance sheets. So if I think about the Fed, let's say, $1 trillion here, $1 trillion there, and it's all the Fed creating it out of thin air and effectively funneling into the economy. If I think about the ECB, well, it's €1 trillion, a couple trillion, and frankly, the euro area could benefit from an additional couple of trillion spending by the ECB. Now, this spending, it should be part of monetary policy, and as Veerathai mentioned, it should be done in a way that doesn't look fiscal and can't be rolled back when the conditions will require that it be rolled back. But is this really well understood, and is this well communicated? So here's the danger. I'll say, as we know, we have many pressures and many desires to support good goals in society. Let me give you an example. Very, very topical for Europe these days, green finance. So in a recent interview, Yves Mersch, an executive member of the executive board of the ECB, was asked about the ECB's role in the efforts against climate change. And one part of his response I found very pertinent for our discussion today. In his understated manner, he said, if in the end central bankers are perceived as politicians, that would not be helpful, in my opinion. In my view, it would be catastrophic if central bankers are perceived as politicians. Say, for example, well, the euro area economy needs $1 trillion or $2 of additional expansion. Why don't we direct the resources of the central bank for this particularly nice goal that we all love and want to achieve? Green finance, so that we can protect the environment. Now, we can all agree this is a very, very important task, but we should also see that, as Yves Mersch was suggesting, it's the politicians who should be seen as handling challenges like that. The job of the central bank is only to help the economy with the financing from a technocratic perspective. Remember, and let me end with this couple of points. Good central banking is boring central banking. It should be about boring technocrats applying their skills to benefit society. It's not about personal fame and looking good. How do we protect central bankers when they have to help with the monetary expansion right now and use the spending power they have? Well, one way to do this is to clearly separate the liquidity that is being provided from the spending decisions. So one thing that has come up in the past few decades in the Federal Reserve's debate is about monetary versus credit policy. One way to do this would be to let the government take all of the spending decisions. Suppose, for example, that you are in the case of the ECB, you want to expand your balance sheet by €1 trillion to help the economy. You can do this by only purchasing government debt, nothing else. So you do not discriminate against any assets, any sectors, any goals, and then tell the governments, you use the money as you see fit. It's a political decision. It's not our job. We're just expanding the balance sheet right now to help out as long as inflation is low. And we will, of course, unwind it as a rule when inflation picks up. So this is number one. Maintain neutrality. Number two, this is the very important point that Veerathai mentioned, to explain that these measures are temporary. But in my view, the best way to explain that these measures are temporary, especially when temporary may mean 5 years or more. This is the sort of temporary we're talking about right now, about how long the balance sheets are going to have to stay long. In my view, the best way to ensure that these measures are temporary is to be systematic. Best way to do this is by communicating something that is as close as possible to a rule. Say, right now, with very low interest rates, the way we need to provide a monetary accommodation is through expanding the balance sheet, through expanding government debt. But we are doing this because inflation is still below our goal and expected to stay below our goal. And we have a rule, maybe explicit, maybe implicit, that will inform everybody and be repeated, that the central banks will unwind these measures when the economy becomes healthier and inflation starts picking up. And especially if inflation starts veering above the target, then the central banks will follow the rule, unwind the measures in a very technocratic and boring fashion. I think this would be a way to defend the independence in the current environment. And again, if the central bankers are seen as politicians, then we cannot justify the current environment with independent central banks.
Thank you, Athanasios. So third panelist is Professor Judge, and I hope she will bring in legal perspectives to this issue. Kathryn?
All right. Well, I'll try to bring in a little of the law, but I think also just building off of Athanasios' point, thinking about the US in particular, because I do think we're facing distinct challenges here. I liked his framing of monetary versus credit, and I want to get even more granular than that. So starting off big picture, I would say if we think about threats to central bank independence, right now we're kind of in a yellow cautionary zone. It looked like we could get worse, but we've been in worse places in the past. It's always a little bit under threat. And so I want to flag why I think things could get worse, but why they are not nearly as bad in terms of the threat to independence as they might have been in light of everything that's happened. So as has already been beautifully summarized, the central banks across the world were responders of first resort. It's a role that they have often had to play. It is one they played this time. We saw central banks, including in the US, move very quickly to quite accommodative monetary policies. A lot of them were already there, and then they had to bring out what are these non-conventional tools. even those at this point are not that controversial because we've seen them deployed so often, depending on which tools you're talking about. So we think about in the US, I think we saw the slashing of interest rates very early on. We saw the commitment to stay at very low interest rates. We saw a massive increase in the buying of treasuries and agency MBS. I mean, that was partly accommodated monetary policy. That was partly, I think, also just to deal with the dysfunction that we saw in the treasury market. Nobody had any questions about any of that. Nobody has any questions about whether the Fed ought to be doing all of those things under the circumstances. Slightly more controversial, but I still think pretty safe, is the Fed rolled out all of the facilities that they had deployed during the last financial crisis. And so what we really learned in 2007 and 2008 is that alongside the banking system, we have a system of market-based intermediation. So just like we need to have the discount window providing liquidity to banks so they can provide liquidity to their customers, we need to provide ways of helping short-term financing markets in the markets-based space. We rolled out the same group of facilities. We could relitigate that debate, but I think at this point, most people seem relatively comfortable with the Fed playing that role, as long as later on we have appropriate regulation of market-based intermediation, which is its own ongoing debate. As we, I think, discussed briefly, the Fed also, just because of the nature of the dollar in international markets, rolled out the swap lines. They created new facilities for repo of foreign central banks. Again, I don't know how much Americans are paying attention to those developments, but I think most people who are watching are very comfortable and feel like that's exactly what the Fed needs to be doing. They're taking on very little credit risk, and they're really helping to maintain dollar liquidity overseas in ways that actually protect it from having to provide direct liquidity to non-US institutions, which I think is part of the reason they've really developed these relationships with foreign central banks. So that's a lot right there. Where they got a little more creative this time around, and where they've shied back, but you can't fully undo a dam once you've broken it, is in credit policy. So even before Congress passed the CARES Act, the Fed stepped forward and said, in addition to making sure that both the market-based system of intermediation, the bank-based system that we have, are in a position to provide credit onto the real economy, we are going to step forward and provide credit directly to the real economy. And as we now know, that was because there were simultaneous conversations that they were having with Congress, with Treasury, where Congress decided we're going to give $454 billion that we want the Fed to lever up. And they're going to work closely with Treasury, which is definitely not independent, and through these policies provide a lot of new liquidity. But really, it's not just liquidity, because this is already alluded to. It's not just that these programs are going to exist for years. It's the nature of the loans that were being made were 4 or 5 year commitments. And so that is where we've really, I think, entered into new territory that has the potential to be dangerous. I think partly for that reason, the Fed has scaled back. So at first it seemed like this fount of creativity. It took a long time for it to operationalize any of those facilities, and none of them have gotten very big. So nominally right now, the Fed has facilities that's enabling it to provide loans to municipalities, loans to nonprofits, loans to mid-sized businesses. But if you actually look, the amount of lending it's doing in any of those spaces is minuscule. It's also it's doing some bond buying, some ETF buying, but there, what was really striking, and this is, I think, where there might be some long-term pushback with the credit policy, is as soon as they made the announcements, we saw spreads go down dramatically. And so I think, given that corporate leverage was already at record levels, and that the Fed's jumping in when they did, not as part of their monetary policy. And this is the legal angle. This was not, we're going to buy up corporate bonds, as some central banks have done, as a way of implementing monetary policy. This is Section 13.3, unusual and exigent circumstances. We're going to effectively take this liquidity risk on ourselves and take it away from market participants. And they basically stepped in and provided a huge backstop to the corporate bond market, both to investment grade and through the ETF, so it's been a smaller program, to non-investment grades. And again, we saw spreads immediately go down upon those announcements. And then we've also seen just record levels of issuance continue really unabated since that time. And meanwhile, as I alluded to earlier, they have not been able to operationalize, and I don't think it was surprising to me or to others who know the Fed system that they've not been able to operationalize a meaningful way of injecting comparable amounts of new credit into smaller and mid-sized businesses. Right now, I don't think the Fed is getting that much grief for this. They're getting a little bit, but the pushback is not as great as it could be. Nonetheless, considering the very significant implications in terms of facilitating finances for the largest corporations while not being able to do much to ease the financing challenges that small and mid-sized businesses are facing, it could have real implications for the structure of the economy that emerges post-COVID. And if we do end up in a world with even more concentration and more consolidated power, which has been a big political issue in the US, that could be, and that could result in political backlash. So I think we don't yet know where that's going to fall out. But it's I think a fragile situation. And the Fed right now is in this weird position of having accepted this $454 billion. They're both saying, we're doing our best, you know, but like, you know, you need to do more. And so like, if they'd said right at the beginning, I think in March, look, we can't provide credit to real economy, it would have been a different story. But there is this kind of this tension that arises from the fact that they originally signaled some willingness and they just have been very uneven in what they've been able to do. The last point I would make, and this again builds off of what already has been said, I think that actually some of the greater threats to central bank independence right now, particularly but not exclusively in the United States, arise not from the expansion of the balance sheet or any decisions that the Fed is making, but by virtue of the fact that we are facing incredibly difficult policy issues, that there's significant unrest around those policy issues, there's hunger for things to be done, and there's no easy way to address them. So I think, as already, again, was mentioned with climate change, I think there's a lot of pressure to try to address it. The Fed can very rightfully say, look, we don't have the right tools to address it, but there's going to be an ongoing tension in that area. I think another area that we're already seeing a meaningful conversation arise is that along with Black Lives Matter, there's been a real attention to the disparate effects of crises and periods of instability on different groups within the economy, within the society, and that there's very significant disparities to begin with. So I think things like the Black-white, the racial wealth gap, like that wasn't something that the Fed has like gone out of its way to say like, look, we can take this on by any means, but nobody knows how to tackle it. Nobody, you know, we have ideas of reparations, but there's not kind of a magic bullet, and there's incredible frustration. So I actually think part of what will be interesting in the United States is it's not just what the Fed is willing to do or is not willing to do, or what its tools situate it well to do, but the fact that we are just facing such significant policy issues, there is such pressing unrest around those issues, that I think there could be additional pressures on a whole variety of different entities to go outside what they have traditionally done and what they are comfortable doing. And we'll see how that plays out.
Thank you, Kate. And before turning to Trish, I abuse my role as a moderator and interject one point about Bank of Japan. So we talked about ECB and Federal Reserve, and I'd like to talk what Bank of Japan has been doing. And especially I'd like to draw attention to the YCC, the yield curve control that Bank of Japan introduced in September of 2016, already 4 years ago. And that says that the BOJ will fix, there's some band around it, but to fix the policy rate at minus 10 basis point, and long interest rate, 10-year bond rate at 0.0%. So very slight slope from overnight to 10 years. But to say that the Bank of Japan will hold the 10-year rate at around zero means that Bank of Japan will buy whatever the amount of the 10-year bonds in the market to stabilize the interest rate, which means that government can issue bonds, and if the rates start to go up, Bank of Japan will buy it. So it is called yield curve control, but in the old day textbook, you could say this is deficit financing, violation of independence. But nobody's saying that, right? This is wonderful institution to have the cooperation between central bank and the treasury, and let the government spend it as the central bank supports it. And this is unusual policy, but I think in unusual circumstances, this is justified. And I see the hands of Athanasios, but I have to, sorry, I violated I couldn't resist. But I let Trish do her discussions, then turn back to Athanasios. Trish.
So thank you, and thank the panelists, and thank you, Taka, for this absolutely fantastic set of points and discussions about central bank independence, and particularly in the last 6 months, what has happened. I have sort of two, start with a comment and with a question. One on the if you like, the counterparty risk and the credit risk that the central banks are taking on, and the second on the fiscal dominance question, which I'll come to in a minute, which I think is very different for different countries. What the U.S. and Japan and the ECB can do is a pretty different list than what small open economies and emerging economies can do in that space. So my question to this is, and I'll put my comments in as I go along. My question in this is a little bit, for the panelists, is more forward-looking. What's very unusual, as Veerathai pointed out at the very beginning, was that the financial system, and economies as well, but the financial system in particular was quite strong globally going into this crisis. Non-financial businesses were over-levered a bit, but compared to previous periods of too much leverage, the system was not very fragile. It was pretty darn strong. So central banks effectively creating a huge number of liquidity facilities, which take on a lot of counterparty risk with the financial system, which, by the way, were highly, highly controversial when they were used in a financial crisis, just for the record. They're completely non-controversial so far, but my question to everyone is this just a matter of time that they're not going to be consequential? Because when we move from this being a solvency problem within the financial system, as well as solvency issues for the non-financial sector, and as Kate pointed out, central bank small and medium-sized enterprise lending programs have not been incredibly big or successful so far, then are we asking for an unbelievable political backlash that the central banks have basically provided all this credit to a financial system, and then the financial system implodes anyway because the economy falls apart. And then it's bailouts. Sorry, I'm painting a very bad case scenario here. On top of not being incredibly effective when they are doing the spending, as Athanasios calls it, for lending directly to businesses. That combination seems to me to be a very dangerous one. And unfortunately, the longer the pandemic goes on and the slowdown in fiscal support in many countries, that seems a more and more real possibility. If you combine that with the regulatory forbearance that Veerathai pointed out that has happened in virtually every country, then not only did you go easy on all the banks and the financial sector, but you lent them all this money and then they lost it anyway. Sorry, that's a very dark scenario, but it seems to me that that is sort of the perfect storm. And I'd be very interested in hearing what you think is right or wrong or just plain crazy about my bad case scenario. I'd like to hear from all of you on that. Veerathai, perhaps you want to start?
Thank you. Thanks very much, Trish. These are very good points. When we decide the financial policies, financial measures, we need to make sure from the outset that the banks have capability to be of help. As you have pointed out, we enter the current crisis with a very strong banking system, and in Thailand, we have created a lot of buffers, looking from bank capital, looking from loan loss provisionings that they have. So we can rely on them to provide some facilities to help the real economy. But one important point, when we do financial policy measures, like we have a soft loan facility whereby we lend to the banks, and the banks can on lend to the targeted SMEs at a very low interest rate. We charge the bank 0.01%, and the banks can charge SMEs at 2%. We have to make sure that there's a line between the decision makings of the bank when they decide which credit risks that they want to take. So in the current crisis, that is a huge uncertainty. The credit distributions will have to be with the expert, which is the bank. As you have pointed out, this facility might not be very well utilized because of very high credit risks out there, and we have to accept the fact that given the uncertainty of the current pandemic, the central bank cannot step in and say you have to help everyone and you have to use up all the facilities. But what we do is that we provide concessionary funding, but the credit risks have to be decided. We have to be decided by the banks. So that's one example when we work with the banks and try to make sure that we draw an appropriate line, and we do have to monitor the situations of the debtors and also the banks on a very regular basis to ensure that all the measures that we have deployed will not lead to financial fragilities of the bank. The other facility, if I may, that we launched, we call the Bond Stabilization Fund. We had problems with the corporate bond markets, and the corporate bond markets have become very large in Thailand, and these are not properly regulated from financial stability perspective. A corporate bond market is not under our jurisdiction. But when the corporate bonds markets was freezing up around March to April, and there was a big redemption run in corporate bond funds, some of the large mutual funds had to close down. And people were very concerned, the market was very concerned about the rollover risks of these corporate bonds. It was a difficult decision for us, but at the end we decided to come up with a facility which provides a backstop for corporate bonds. The basic design is that the company is issuing corporate bonds. We have to get majority of their maturing bonds roll over from the market, but we charge the highest interest rates to ensure that we'll be the last resort, and we'll be providing just only the top up facility on a very short period, like a bridge financing, and we do accept only those with a very high rating. It was a big debate. Everyone wanted the central banks to go beyond the investment grade, to take care of the foreign angels as well. They look at the Fed and they say, if the Fed can do it, why can't the Bank of Thailand do the same? This is the counterparty risk that we're very concerned with. So in the design, we have to make sure that we cover all these points and build all these points into the details of the design, and make sure to the public that you have to be very explicit to the public that we do this facility as a backup facility, to ensure financial stability. It's not to stimulate economy. It's not a QE as certain central banks may have deployed. It's only for financial stability purpose. So those are my comments. Thank you.
Thank you. And to the audience, if you have questions, please send in to the Q&A box. And we will use the webinar buffer. So we'll to 15 minutes past. So we have 25 minutes to go. And I noticed that Athanasios had his hand up in reaction to my YCC comments, I believe. So Athanasios.
Thank you, Taka, and thank you, Tricia. I will actually address Tricia's question as well as comment on YCC. I think they are related, very much related right now. And let me start by reinforcing Veerathai's point about what the central bank can do and what the central bank should tell the government to help with. The central bank can provide liquidity, and it should not be really taking the credit risk, but it should be telling the government that the government can help by taking on credit risk that can then facilitate the financing of small, medium enterprises, that can facilitate the situation of firms that may be really close to becoming insolvent, because this is a macroeconomic situation, and this is the role of fiscal policy under those circumstances. Now, what can the central bank do? I'm going to link this to Tricia's question. And what is the danger? The danger is to be overcautious. We've seen this, unfortunately, starting, I'm going to say, in the modern era with the Great Depression, when central banks, at the time, the two major ones were the Fed and the Bank of England, they were too overcautious in using their tools to keep the economy growing. What do I mean by that? The central banks can help tremendously to keep nominal income growing at a healthy pace. And by doing that, you can actually avert the problem of debt deflation and liquidation. That is really what creates this deep, dark scenario that Trish mentions. Central banks do have the power to do that with monetary policy. And we're talking about situations where inflation is below central banks' goals. So it's really very easy for central banks to justify incredibly accommodative policy to help inflation go up to their goals and support the economy, and in this way avoid liquidations and avoid the dark scenario. Now let me link this to YCC. How do you do monetary policy accommodation? Well, in the advanced countries, with the equilibrium real interest rate being about zero, what you need to do is what Keynes already in 1930 told us to do. This is what the Bank of England said, didn't listen to him at the time, which is buy long-dated securities, buy long-term government debt to bring the long-term interest rates as much as necessary down. This is what we now call quantitative easing. And this is what the Bank of Japan is doing. And in my view, the Bank of Japan is doing this in a very efficient way by actually announcing that they want to keep the 10-year yield at close to zero for the time being, which as a rule is good policy as long as inflation continues to be so much below their 2% target, which it currently is. That actually makes it less efficient and requires fewer purchases of government debt than we saw before they implemented YCC. Before they implemented YCC, they actually needed to have a faster pace of purchases to keep the long end of the term structure down. And since YCC, it's much more efficient. So actually, that's exactly the policy that I think other advanced economy central banks could follow to be very efficient, provide the accommodation, and be neutral. Because you're just buying government debt because your inflation, if the inflation rate is below your target, and you let the governments figure out whether they're going to finance in Europe. If they want to spend $1 trillion on green finance, that's fantastic, but it should be the politicians' decision. It should not be the central bank decisions. And right now, the central bank should be telling them also help out SMEs, help out corporations that may be close to becoming insolvent. This is the role of fiscal policy to make sure we sustain the economy.
Thank you, Athanasios. I think if the BOJ is listening to this webinar, they are grateful to your comments. Kate?
Yeah, let me actually pick up right on that point, because I mean, we know that the Fed recently considered YCC and opted to go a different route. And even though it looks disconnected from Trisha's original point, I actually think that there might be a connection there. I mean, we know that the Fed decided to try to revisit the framework even before the COVID crisis set in, and that was because we just weren't seeing what they expected to see in terms of the effect on inflation, even as unemployment continued to go down. So clearly the models they had weren't working, there was a need to revisit. But part of what was interesting about the timing of when they issued the revised framework and when they're coming out with this idea of like, we'll allow the economy to run hot, we'll allow ourselves to go over 2%, we're gonna aim for averaging over time, is in a weird way, they're managing to get a huge number of headlines about how the Fed is like going out there to really care about unemployment. They are showing their commitment to like, you know, making sure we have maximum employment. They're helping people out by making it so that we're able to like, you know, have a situation where unemployment can be 3.5%, and they're going to keep allowing it to go lower because like that's how they're really going to help out the people on the margins. And so part of what's interesting is they're managing to have, going back to, I think part of Trisha's question is like, they haven't seen blowback yet. One mechanism where they could see it in the future is through banks, because guess what? They're also a bank regulator. The Fed is one of the only major central banks that did not immediately stop all distributions from large banks. And there's a lot of losses that are out there. We don't yet know how big they are. So even though they were much better capitalized coming into this crisis than they were in the past, like we just don't know where that's going to land out. So that could be a way that we end up seeing pushback. And I was talking earlier about other ways we could see pushback, but I do think it's actually been very clever because, I mean, we were already in a stage where we are at incredibly low interest rates. We are going to be there for a very long period of time. We're already seeing contestation from governors and presidents of some of the regional banks over what the revised framework actually means in practice. But it allowed them to create all these headlines where they're reaffirming that story of, you know, we care a lot and we're doing a lot to promote employment in a way that doesn't actually have any material effect on their policies for at least the next couple of years, and is pulling attention away from the decisions they're making in areas like bank regulation and in areas like credit policy, where I actually think that there could be a lot of more contestation. So even though they seem separate, I actually think it is part of what is enabling them to not be as much in the heat right now as they might be. And I think Trisha's bigger point, which I really like, is whether they're going to be able to avoid that or whether it's going to come back to bite them is going to depend a lot on just what happens in the coming months and the coming years. And we don't know that yet.
So I obviously, from the nature of my comment / question, I completely agree with that. I think it's incredibly dangerous. I do not disagree that they're, in the current circumstances, the quasi-fiscal nature of what central banks, not just the Fed, but around the world have been doing is helpful and could be helpful. What it certainly did was instill a lot of confidence effects. And from Veerathai's example in Thailand to elsewhere. But if that confidence, particularly within the financial system, goes away, I think unfortunately the risks to central bank independence, not to mention to the global economy and the global financial system, are a lot bigger. So I have one more question since Taka said we can have a little extra time here. And that's a contrast across countries. Athanasios is starting to sound like a new modern monetary theorist to me. But I know that's not true. Yes, I know. But the idea for large advanced economy central banks that when your inflation is below target, that basically buying lots and lots and lots of government debt can get your nominal GDP to where you want it to be and help the economy stay afloat is as you say, Keynes told us that in the 1930s. But I want to ask a question about the applicability of that idea, even when your inflation is below target, to small open economies who are much more vulnerable to international capital flows, not to mention who may have a history of where central banks have not been so independent and a history of fiscal dominance and balance of payments crises. That seems a huge risk to me to central bank independence, but many emerging market economies, as Veerathai pointed out at the beginning, have, in some cases, for the first time or the first time in many years, have been buying government bonds. So I would be very interested in hearing your views about the riskiness of that. I think I know what Athanasios is going to say, but everyone else is, what risks do you see, particularly for smaller economies, emerging economies, for QE, particularly if the QE ends up having to be quite large?
Okay, Veerathai followed by Athanasios. Veerathai.
I think it's a very good question when we see central banks of advanced economies deploying QEs. People also ask why central banks of emerging markets don't do the same. I think there is a limit on how central banks of emerging markets can do with balance sheet policies. I mean, our currencies are not reserve currencies, and that will have implications on exchange rate and other macroeconomic policy considerations that we need to take into account. But in terms of public debt financing, that is not the case in Thailand. We do buy government bonds only for monetary policy purpose or financial stability purpose. We have kept our interest rate low. Currently, is at a historic low at 0.5%. And is an excess liquidity out there. We still have to mop up excess liquidity by issuing a Bank of Thailand bond on a regular basis. The government they have to expand their borrowing requirements substantially because of the current crisis. But even that, they can borrow at a very low interest rate. 2-year government bond at 0.7%. 10-year government bond at about 1.6, 1.7%. So they can rely on liquidity in the market, and that is not an issue for government bond. What is more of a challenge, if I may go back to your earlier questions, Trish, and I think it's also related. The issue that we face now is not the overall liquidity in the financial system, but it's the distribution of liquidity to the segment that is needed. And this is also related to the point that Athanasios mentioned about to which extent the central bank should get involved. When we have this issue about the distribution of liquidity in the system, not so much on the overall liquidity. In normal time, we may need to depend on the banks and let the banks be the distributioner of liquidity. But in the period of with a very high degree of uncertainty, and banks also have to be very cautious about the lending. That's a big challenge. So we have to think of combinations of financial policies. It's not just only monetary policies. We have said that we don't see much transmission mechanisms of further lowering the interest rate from the very low level now. It's more of the financial policies that we have to bring into play. And this might include things like credit guarantee by government state-owned financial institutions, credit guarantee to certain segments. We might provide some cheap funding that can be on lend to these segments. We have to think more of financial policies for the SMEs and also for the household. We have also created some new types of products leveraged on fintech. Basically, the like of digital personal loans, whereby people can get funding at a much lower rate than the informal market that they have to rely on. And by doing this, it provides some liquidity to the households. The challenge, looking ahead, if I may, and this is related to Trish's questions, I think. The biggest challenge for central banks is how to disengage from all these unconventional policies when there's a high degree of uncertainty down the road, and when public, the government and fiscal policies also has very limited policy space. By designing disengagement strategies, I think is required the science and the art of central banking. We have to make sure that we can, design our disengagement strategy with the government, and also with public. The public will have to understand how much and how long the central bank should do all these unconventional measures. But it's also a big challenge when advanced economy central banks continue to deploy these unconventional policies to the extent that we don't know which one is unconventional, which one is the new conventional. So by deciding this engagement, I think this is a big challenge for central banks.
Okay, so Athanasios, is YCC MMT? Is inflation targeting in a stone to make sure disengagement will be possible smoothly?
Thanks, Taka, for framing it in this way, because I think this is the correct way to frame it in addressing Trish's question. And no, YCC is not MMT. So we need to realize that the problem we're facing right now is not just a pandemic and a deep recession or something that could become, if central banks don't make sure the economy keeps growing, it will, of course, become a financial crisis. Of course, central banks can create a lot of damage by not sustaining growth in the economy when they can. Problem is that right now, in the advanced world, policy is constrained by the zero lower bound. This is what we did not face 50 years ago or 40 years ago. And yes, when policy is constrained by the zero lower bound, balance sheet expansion and purchases of government debt is the conventional way to expand policy. And the major mistake that central banks can make is not realize that and say, no, we should not do balance sheet expansion and so forth, because then you end up with a deflation situation and the economy is just gone. But it also tells us, if we put it in this context, that is not the problem that is being faced by many or most, I would say, emerging market economies. In emerging markets, there is still room for conventional easing if central banks need to apply additional conventional easing. So it's not the same thing to say, let's start buying government debt when the interest rate is at 4%, and you could still cut by 400 basis points. First, you cut by 400 basis points, and only if that's not enough, then you examine how to do balance sheet expansion. So in direct response to Trish's question is that no, it would not be advisable for emerging market economy central banks to do balance sheet expansions and buying government debt in these circumstances when they still do have quite a bit of room to ease monetary policy. So this is one thing. In terms of the YCC, again, for advanced economy central banks, the estimates of the real equilibrium short-term interest rate right now are 200 to 300 basis points below where they were 15 years ago. And if you have a short-term interest rate, the safe short-term real interest rate at 0, then you have to keep the whole term structure of interest rates very low. Otherwise, your policy will be excessively tight, and you will actually end up with inflation being too low in the advanced world, which will actually make the global economy not be growing sufficiently and create problems everywhere. So it's really critical for advanced economy central banks to keep doing quantitative easing as needed. And then the question, how do you get out of it? This is Veerathai's question at the end. This is why I think it's very important to tie this to rule. And Taka, this is all about the inflation goals. If central bankers, while they are doing quantitative expansions now in advanced economies, keep repeating that this is a temporary measure that will be unwound when inflation overshoots their target, because they want to maintain price stability in the long run, with inflation effectively 2% on average in the long run. And because they want to be symmetric about it, that actually is the best way, in my view, to maintain their independence, to protect their independence in the long run, because it will actually allow them, when they do have to start tightening policy, to say, look, we're just doing what we've been telling you all along for the past 6-7 years when we were expanding our balance sheet in this manner. And this will be the legitimate thing to do. It's important to be symmetric when central banks do this. And in terms of commenting about the Fed's announcement in August about the slight, I mean, I only look at this as a pretty slight revision in the framework. I was waiting for more revisions, to tell you the truth. But the one thing that I see as being important in that is trying to reinforce the message that they want inflation to be 2% on average. And since they have been undershooting for a while, they're more willing to take risks, temporary risks on the upside, to make sure inflation is at 2 on average. And this does have an immediate positive effect. It reinforces inflation expectations from becoming lower, which means real interest rates across the term structure are a little bit lower. And that actually is alone helping out the monetary policy, even if they don't do anything else.
So one question from the audience is that the fact that the actual inflation rate has been persistently lower than the target 2%, isn't that be a problem in central bank independence? That the central bank, I think it means that credibility, that central bank may lose credibility and becomes a problem in the independence. And so if anybody wants to take up that question, that's one. Another comment I want to interject is again that BOJ has already mentioned this overshooting commitment after the undershooting for so many years. Again, back in 2016, September, at the same time that they introduced YCC. So they have been trying and try to influence the inflation expectation by committing to overshooting. But you know, the moment overshoot hasn't arrived yet. So it's not been tested. So Kate, you want to comment on something?
Sure, I'll jump in on both of those just briefly. I actually don't see the persistent shortfalls as having as deleterious effect on credibility or on independence. And it depends a little bit on the reasons for the shortfalls. And this really builds off of what Athanasios was just saying. It depends on what tools they have available and what tools you want them to be using that they are not using. And so when you're at the zero lower bound, when you have a balance sheet the size that the Fed's been consistently, I mean, it was shrinking, but it was still not a small balance sheet, even before we got into this period. It's different than in a situation where they're undershooting on inflation and we have high unemployment and there's like tools that are readily available that they're not readily deploying. We are instead in a situation where unemployment was consistently going down. They were in a very accommodative stance. And I just don't think, I think threats to credibility, threats to independence really comes when there's outcomes that people feel uncomfortable with. You know, people don't understand the nuance in the same way. So as long as, unemployment was still on that downward trajectory, you're just not going to get a public backlash saying you said 2% and you're not hitting 2%. But I'd be open to other views.
Okay, so we have about 5 minutes to go. So I'd like to give the last words to each panelist in the same order we had it in initial remarks and Trish. So Veerathai.
Taka, if I may, I'll make a remarks on the last questions you have on undershooting inflation and whether that will have implications for central banks' independence. I fully support the points that Kate has just mentioned. It depends on the reasons why we have undershoot inflation. During my 5-year terms at the Bank of Thailand, I would say more than 50% of the period we have undershot our inflation target. And indeed, we had to lower the range of inflation target to make it more consistent with the actual structural changes in the real economy. We have observed a lot of structural changes, like the cost of technology has come down substantially, or the technology-related products have come down. I mean, the platform economies has also taken away the pricing power of many firms. For Thailand being an oil importing country, global oil prices have a supply shocks, which can be positive supply shocks leading to undershooting of inflation. But what is most important is the need to explain to the public of our monetary policy framework. We have what we call the flexible inflation targeting framework. We look at price stability. We look at potential growth versus potential growth of our economy. And we also need to take care of financial stability. So we have to weigh between these three objectives. It's not just only trying to achieve the inflation target alone at all costs. That's not the way central bank should operate. There's, obviously every policy measures have costs attached to it. So we have to have a proper balance. So they need to communicate that to the public clearly of how we look at balancing these three objectives is very key to maintaining credibility of the central bank. Thank you.
Thank you for your time. Athanasios, last word.
Thank you, Taka. So it's briefly on the symmetry question. I think central bankers protect the independence of central bank best and the independence of monetary policy if they're clear about the goal and take symmetric risks around them. So yes, policy should be guided by trying to be symmetrically around the inflation goal over the long run. Ultimately, and for the main topic of our discussion, my last word would be to protect the independence of central banks. We need to be careful to have central bankers that do not look like politicians. Just stick to the job technocratically, try to keep the economy growing, keep price stability, and let the politicians do the spending.
Thank you. Kate?
I don't know how much I can add on that. I mean, I think sadly we've left the world where they're pure technocrats or where they can be seen like pure technocrats. But I think that actually kind of times increase their independence if they know how to communicate more broadly. I mean, I think at least in the US, we saw Powell doing at the very beginning what Bernanke took a year to do, which is going on 60 Minutes and saying to the public, I hear you. And I agree that doesn't mean they should sound like politicians. They should be very clear about the limits of what they are able to do and the natures of the tools that they have available to them. But in a surprising way, I actually think the lesson learned of not just here are the tools that we have and let's use them aggressively, but let's like make the public feel like we are listening to them has actually been helpful in terms of maintaining independence.
Thank you very much. Trish?
Well, first of all, I want to say thank you to everybody. This was a great panel. I really enjoyed it. And you brought up, I think, all the key issues, including a whole bunch that I hadn't thought very hard about at all. I think the biggest risk to central bank independence will be political second guessing. This is central bank policy works across all of the dimensions that we've been talking about today, works in part through confidence effects. This is a viral pandemic. At some point, there's a risk that those confidence effects which is a potent tool, whether it's in regulatory forbearance or monetary policy or lending or policy or whatever, And if that gets overwhelmed, central banks who've gone all in, as they appropriately should have, I think may unfortunately face bigger political risks in the future. I hope I'm wrong. I very much hope I'm wrong. But I do continue to think that depending on how the real economy globally evolves, that we could see some tough future days for central bankers.
Okay, thank you very much. Unfortunately, time is up, and we have to end this wonderful webinar. Thank you very much, Governor Veerathai. Thank you, Professor Athanasios, and thank you, Kate Judge. So this will be the end of this the webinar on implications of central bank independence. Thank you very much.